When people say the Federal Reserve controls the economy, this is what they mean. The base rate is the interest rates set by a country's central bank. It's the rate commercial banks pay to borrow money. The central bank charges the commercial bank, and this rate then affects the rates they offer on savings and loans to customers like you and me. In October, the Fed cut rates by 25 basis points. That's 0.25%. And more cuts are expected. And when the base rate falls, the return on safe assets falls with it. And when that happens, investors start moving their money. Because investors aren't chasing returns, they're chasing the best return for the amount of risk they are taking. So every time the Fed cuts rates, savings accounts become less attractive and people go hunting for better returns. That's when you start seeing stock prices rise because future profits get valued more. Property prices rise because borrowing gets cheaper. We've seen this before. In 2020, rates went near zero. Costs to borrow were minimal. Liquidity exploded. Stocks, real estate, tech, collectibles like art, everything rose. Then,
in 2023,
inflation was at 7% due to so much money in the system, and they needed to bring it under control. So they made borrowing money more expensive. And the Fed hiked the rate above 5%. Riskier assets corrected. Money flowed back into treasuries. Now, as the Fed begins cutting again, the cycle is reversing. Rate cuts lower the price of money. Cheaper money, more demand. More demand, higher asset prices. The Fed doesn't tell the markets what to do. They change the base rate, and everything else moves in response.